By the time this video ends, 150 people in the world will have officially become new millionaires. Most of them weren't born into it. They didn't win the lottery. They didn't have a lucky break in a speculative tech stock. They simply understood a code that you were never taught in school, a code that is hidden in plain sight, buried under the noise of consumerism and bad advice. Most people think investing is a playground for the rich. That is the first lie designed to keep you trapped in a cycle of earning and spending. Today, I'm going to show you how to turn a few dollars a day into a mountain of freedom. We are going to deconstruct the exact psychology of the 1% and build a step-by-step roadmap to wealth that works. But before we dive into the numbers, you need to understand the critical curve. If you miss the turn at the end of the wealth cycle, you lose everything. Stick with me because as we progress, I'm revealing the golden asset that most beginners overlook, which is actually the engine of all self-made fortunes, the psychology of the money software. Before we talk about stocks, real estate, or compound interest, we have to fix your money software. You see, your brain wasn't designed to build wealth. It was designed for survival on the savannah. This leads to a massive psychological hurdle called loss aversion. Evolutionarily, losing a meal was more dangerous than finding an extra one. Today, that translates to us fearing the loss of $100 twice as much as we enjoy gaining $100. This is why most people keep their money in a safe savings account. But here is the cold, mathematical truth. Safe is a dangerous illusion. With inflation devaluing currency, a stagnant savings account is a guaranteed way to lose 50% of your purchasing power over the next 20 years. You aren't saving money. You are watching it slowly evaporate. You've likely been told by gurus to stop buying coffee or eating avocado toast to get rich. That is small money thinking. You cannot shrink your way to greatness. Wealth isn't built by cutting out the small joys that make life livable. It's built by expanding your gap. Imagine a graph. On one side is your income, on the other are your expenses. The space in between is the gap. Most people, as soon as they earn more, they spend more. Their gap stays thin. The wealthy focus on widening that gap through two levers: increasing income and optimizing, not just cutting expenses. You don't save just to have a pile of cash. You save to invest. Every dollar you put into the gap is a freedom soldier that works for you 24 hours a day, 7 days a week, without ever asking for a vacation. The eighth wonder of the world. Albert Einstein reportedly called compound interest the eighth wonder of the world, adding that those who understand it earn it, those who don't pay it. To understand why time is more important than money, let's look at the story of Ben and Arthur. Ben starts investing at age 19. He puts away $2,000 a year, about $160 a month, into a standard index fund. He does this for only 8 years, and at age 27, he stops completely. He never adds another cent. Arthur waits. He enjoys his 20s and decides to start at age 27. He invests the exact same $2,000 a year, but he does it every single year for the next 38 years until he's 65. When they both reach 65, Ben, who only invested for 8 years, has more money than Arthur, who invested for nearly 4 decades. This is the cost of delay. Every year you wait to start doesn't just cost you that year's savings, it costs you the final largest double at the end of the curve. Wealth is not about timing the market or waiting for the perfect moment. It is about time in the market. When you buy a stock, you aren't gambling on a ticker symbol. You are buying a piece of a living, breathing business. When you buy an index fund, you are betting on the collective ingenuity of thousands of CEOs, engineers, and workers. You are betting that tomorrow, the world will be slightly more efficient than it is today. The wealth order of operations. Now, let's get tactical. You need a system so you don't have to think. We call this the wealth order of operations. Step 1. The starter emergency fund. You cannot build a skyscraper on a swamp. You need $1,000 to $2,000 tucked away in a separate account immediately. This is your life happens fund. It turns a blown tire or a broken water heater from a financial tragedy into a mere inconvenience. Step 2. The debt snowball. High-interest debt is a leak in your boat. If you have credit card debt at 20% interest, you are in a financial emergency. No investment on earth will consistently pay you 20%, so paying off that debt is effectively the best investment you can make. Step 3. The employer match. This is the only free lunch in finance. If your employer offers a retirement match, you take it. If you put in $1 and they put in $1, that is a 100% return on your investment before the market even moves. You would be statistically insane to walk away from that. The vehicle versus the asset. This is where most beginners get confused. They ask, should I buy a Roth IRA or a stock? That's like asking, should I buy a garage or a car? A Roth IRA or 401k is the garage, the account. The index fund or stock is the car, the investment. You need to pick the right garage to protect your car from the tax man. The Roth IRA is the holy grail. In a standard brokerage account, when you sell a stock for a profit, the government takes a cut. In a Roth IRA, you pay taxes on the money before you put it in, but then it grows tax-free forever. If you invest $5,000 and it grows to $1 million over 30 years, you keep every single penny. The government gets zero. This is the most powerful wealth-building tool for the average person. Then there is the traditional IRA or 401k. This is the opposite. You get a tax break now, which is great for high earners, but you pay taxes when you take the money out in retirement. Over a 30-year career, the difference between investing in these tax-advantaged accounts versus a normal account can be hundreds of thousands of dollars. You aren't just fighting the market, you are fighting the erosion of your wealth by the state. The technical blueprint. What to buy. So what goes inside these accounts? Most people lose money because they try to find the needle in the haystack, the next Amazon. But why look for the needle when you can just buy the entire haystack? An index fund is essentially a basket. Inside that basket is a small piece of the 500 largest companies in America. This is the S&P 500. When you buy one share of an S&P 500 index fund, you instantly become a partial owner of the world's most powerful corporations. If you want to be truly sophisticated while doing the least amount of work, you use a total market index fund. It gives you exposure to every single public company. You win when the economy wins. But beware of the expense ratio trap. This is the secret killer of wealth. Some funds charge you 1% of your total balance every year just to manage the money. That sounds small, but over 30 years, a 1% fee can eat 2/3 of your potential gains. You want passive index funds with fees as close to zero as possible. You want your money working for you, not your broker. The golden asset and the red sale, I promise to reveal the golden asset. It isn't Bitcoin, and it isn't gold. The golden asset is your earning capacity. In the early stages of wealth building, your ability to trade your skills for income is your greatest lever. If you have $1,000 to invest, putting it in the stock market might make you $100 in a year. But if you spend that $1,000 on a certification or a skill that allows you to negotiate a $10,000 raise, you have achieved a 1,000% return. The wealthy invest in themselves until their portfolio is large enough to take over the heavy lifting. Now let's address the elephant in the room: fear. What happens when the market crashes? This is where the psychology of the red sale comes in. Most people see a 20% drop in the market and panic. They sell everything and lock in their losses. But think about your behavior at a clothing store. If your favorite shoes were 20% off, would you run out of the store screaming in fear? No, you'd buy 2 pairs. The stock market is the only place where people run away when things go on sale. To be a successful investor, you must train your brain to see red days as opportunity days. Avoiding the dopamine trap. The reason most people fail isn't a lack of intelligence. It's a lack of temperament. We live in a world designed to trigger our dopamine traps. Apps make trading feel like a video game. Social media makes meme coins and get-rich-quick schemes look like the norm. But this isn't investing, it's financial entertainment. Real wealth building is profoundly boring. It's like watching grass grow or paint dry. If your investing strategy is giving you an adrenaline rush, you aren't investing, you're gambling. Successful investing requires you to embrace the rule of 72. If you want to know how long it takes for your money to double, divide 72 by your expected annual return. At a 10% return, which is the historical average of the stock market, your money doubles every 7.2 years. Imagine your money doubling, then doubling again, then doubling again. This is how ordinary people with ordinary salaries become multimillionaires. They didn't do anything exciting. They were just consistently, stubbornly patient. The power of no. Knowledge without action is just a hobby. Most people will listen to this entire breakdown, feel a temporary surge of motivation, and then do absolutely nothing. They will go back to their default settings. But I want you to reconsider what we are actually talking about. This isn't about numbers on a screen or having a fancy car. The wealth code is about the power of no. It's the power to say no to a toxic boss. It's the power to say no to a job that keeps you away from your children. It's the power to say no to the anxiety that comes with an unexpected medical bill. Wealth is the ability to own your time and your choices. The best time to plant a tree was 20 years ago. The second best time is right now. You don't need a fortune to start, you just need to start. Break the seal of fear. Open your first account today. Put in $5. Prove to yourself that you are no longer a spectator in your own financial life. This is your journey. The math is on your side. The time is now. Start today.